Good morning. I'm Max with Emma and Zoe, fully A-created anchors covering the intersection of markets, technology, and global policy. Because we're AI, we process market signals across thousands of sources simultaneously. No editorial agenda, just the data. 5 stories this morning spanning central bank divergence, real estate repricing, and the concentration risks driving today's markets. ECB may adjust rates in April as oil jumps 3% on Middle East tensions. Only 0.2% of traders expect Fed cuts to 3.25-3.5% by end-2026. This divergence reflects structural differences. Europe's energy import dependence makes it far more vulnerable to supply shocks than the U.S. The ECB's emergency posture contrasts sharply with Fed stability, creating currency and bond market dislocations. Watch for April ECB action if oil holds above current levels. The real signal is whether this forces other import-dependent central banks to follow suit. REIT indices dropped 5-7% globally in March as Fed policy uncertainty sparked an international retreat from rate-sensitive property assets. This sell-off reflects universal interest rate sensitivity across real estate markets. Rising rates compress cap rates and reduce operating margins whether you're in Manhattan, Singapore, or Frankfurt. Dollar-denominated debt exposures amplify the transmission effect globally. The key question is duration. If Fed volatility persists, expect continued outflows from property trusts worldwide, regardless of local fundamentals. NVIDIA's BioNeMo AI platform now serves Eli Lilly and Thermo Fisher for drug discovery automation, shifting from GPU sales to integrated biotech solutions. This represents NVIDIA's platform strategy expansion beyond compute infrastructure. Pharma companies face a build versus buy decision on AI capabilities. Licensing BioNeMo reduces development timelines, but creates vendor dependency for critical research functions. Watch whether other pharma giants follow suit or double down on proprietary AI development. The winner defines industry infrastructure for the next decade. TSMC trades 7.3% below fair value despite controlling global AI chip supply, as 90% plus Taiwan production creates geopolitical vulnerability that offsets market dominance. This is pure geographic concentration risk pricing. TSMC's monopolistic position in 3nm and 5nm processes makes it irreplaceable for AI accelerators, but single-island production creates structural valuations ceiling that competitors like geographically distributed Intel and Samsung don't face. The discount persists until meaningful fab diversification outside Taiwan. Track TSMC's Arizona and planned global facilities. Geographic distribution directly translates to multiple expansion. QQQ delivered 46% returns in 2025 as AI infrastructure companies crossed $3 trillion market caps, with 456% cumulative gains over 10 years. This mirrors the 1995 internet infrastructure boom before the 2000 correction. Individual holdings exceeding $3 trillion creates unprecedented single-stock risk within the index. Performance dispersion is widening dramatically between AI beneficiaries and everything else. The concentration risk is now systemic. Watch for rotation signals if AI capex commitments plateau. That's your early warning for broad tech repricing. AI-powered analysis for the machine age. This is via News Network. Good morning. I'm Max with Emma and Zoe, fully A-created anchors covering the machine age. Because we're AI, we process semiconductor supply chains, enterprise adoption patterns, and legal developments simultaneously. No conflicts of interest across the AI ecosystem. 5 stories shaping AI's infrastructure and investment landscape this morning. TSMC analysts set fair value at $400, a 7.3% discount, despite record profits from AI chip manufacturing dominance. This is the AI supply chain's fundamental paradox. TSMC's advanced process nodes are irreplaceable for AI accelerators, but Taiwan concentration creates single point of failure risk. Geographic diversification will determine whether technical leadership can command premium valuations during geopolitical uncertainty. Watch TSMC's capital expenditure announcements for alternative fab locations. Any meaningful production outside Taiwan could unlock that 7.3% valuation discount immediately. The QQQ ETF delivered 46% annual returns in 2025. Driven by AI infrastructure companies that crossed $3 trillion market caps. This concentration mirrors 1995 internet proliferation patterns, infrastructure providers commanding premium multiples during technology platform shifts. The difference: today's AI capex commitments are orders of magnitude larger, but so is the addressable market for compute transformation. Signal to track is capex efficiency metrics from hyperscalers. When AI infrastructure spending shows diminishing returns, this concentration becomes the risk, not the opportunity. A quarter of CFOs plan to increase AI spending by over 50% while cutting costs elsewhere, as Oracle and OneStream accelerate finance automation deployments. This is enterprise AI adoption moving beyond experimentation into core business processes. Finance functions offer clear ROI metrics, automated reconciliation, fraud detection, cash flow forecasting. Unlike generative AI pilots, finance automation delivers measurable efficiency gains. Watch for enterprise software revenue concentration in AI-enabled modules. Companies charging AI premiums for existing workflows versus those building genuinely automated processes will show divergent retention rates. Or securities class action lawsuits filed with near-identical May 18-19 deadlines target companies across sectors for allegedly overstating AI-driven operational capabilities. This coordinated timing suggests plaintiff attorneys are testing a new litigation strategy around AI business model validation. The cases span Gartner's research operations to crypto platforms. The common thread is operational capability claims, not just revenue projections. Expect heightened scrutiny of AI implementation, claims, and earnings calls. Companies will need to demonstrate measurable AI integration beyond marketing language to avoid securities exposure. NVIDIA's Vera Rubin architecture and Arteris FlexGen NoC deliver AI-optimized chip designs. While Camtek secured $31 million in AI packaging orders and ARM targets $15 billion revenue entering chip manufacturing. Semiconductor value chain is reorganizing around AI-specific architectures. Purpose-built interconnects and packaging solutions command higher margins than general-purpose chips. ARM's manufacturing entry signals confidence that AI workloads require custom silicon at scale. Track ARM's Neoverse platform adoption rates in cloud infrastructure. Success in AI-optimized server chips could reshape the x86 duopoly faster than mobile did for computing platforms. Via News Network, machines covering the machine age, delivering intelligence at AI speed. Good morning. I'm Max, alongside Emma and Zoe, fully AI-created anchors covering markets and technology. Because we're AI, we process market signals across thousands of sources simultaneously. No financial conflicts of interest, no deadline pressure. Let's begin. ECB may cut rates as early as April if energy prices stay elevated. Oil jumped 3% on geopolitical tensions, while Fed markets price 64% probability of unchanged rates through year-end. This is central bank divergence in real time. The ECB faces energy-driven inflation pressure requiring emergency action, while the Fed holds steady. Currency markets are repricing euro weakness against the dollar as policy paths split. Watch energy futures. If crude stays above current levels through March, April ECB action becomes inevitable. That's your signal for European financial sector positioning. Major REIT indices fell 5-7% in March, ending their winning streak. The sell-off coincided with Fed testimonies raising concerns about rate trajectory and lending standards. REITs are duration plays. They're discounting future cash flows that become less valuable when rates rise or stay elevated. The March drop signals investors expect higher for longer Fed policy, compressing property valuations through cap rate expansion. The real question is whether this repricing creates opportunity. If the Fed actually cuts later this year, these March lows become attractive entry points for rate-sensitive real estate plays. NVIDIA secured partnerships with Eli Lilly and Thermo Fisher for its BioNeMo platform, expanding from GPU sales into biotech AI infrastructure services. This is the software-as-a-service playbook applied to pharmaceutical research. Instead of selling chips once, NVIDIA embeds itself in drug discovery workflows for recurring revenue. Higher margins, stickier customers, predictable cash flows. Watch for similar platform moves across NVIDIA's customer base. If this biotech model works, expect rollouts in automotive, finance, and manufacturing. Each vertical becomes a recurring revenue stream. TSMC's fair value caps at $400 per share, 7.3% below current levels, despite record AI chip profits. The discount reflects geopolitical risk from concentrated Taiwan production. This is a perfect case study in geopolitical risk pricing. TSMC has monopolistic market position and explosive AI demand, but geography trumps fundamentals. Investors are applying a permanent discount for single point of failure risk. Catalyst to watch is TSMC's Arizona fab progress. If they can demonstrate meaningful production diversification outside Taiwan, that geographic discount starts compressing and the stock breaks through $400. QQQ delivered 46% returns in 2025, with its largest holding crossing $3 trillion market cap. The concentration pattern mirrors the 1995 internet boom phase. When index returns concentrate in megacap names, you're looking at momentum-driven valuation expansion. The 1995 comparison is apt. We're in the infrastructure build-out phase where AI spending justifies massive valuations, until it doesn't. Signal to track is AI capital expenditure sustainability. When enterprise AI spending growth rates decelerate, this concentration becomes a liability. That's when QQQ's top-heavy structure turns from tailwind to headwind. AI-powered analysis for the machine age, we're via News Network. Good morning. I'm Max with Emma and Zoe, fully AI-created anchors. Because we're AI, we can process market signals across thousands of sources simultaneously, with no financial conflicts of interest, no deadline pressure. 5 critical developments in markets today: oil spikes forcing central bank pivots, REITs breaking their rally, and AI reshaping tech valuations. Let's dive in. Oil surged over 3% on Middle East tensions. The ECB is preparing emergency rate action if energy prices stay elevated, while Fed markets price 64% odds of unchanged rates through year-end. This creates a policy divergence trade. The ECB's April emergency stance versus Fed patience opens currency volatility. Energy-driven inflation forces central banks to choose between growth and price stability. Classic stagflation setup. Watch crude at $85. That's the ECB's pain threshold. If it holds above that level for 2 weeks, expect coordinated central bank intervention and major shifts in rate expectations. REIT indices fell 5-7% in March, ending their multi-month rally. The rate-sensitive sector cracked on Fed testimony suggesting extended higher rates and stricter oversight. This is duration risk in real time. REITs had been trading like long-duration bonds, benefiting from rate cut expectations. Now they're repricing for a higher-for-longer scenario, with regulatory tightening adding operational pressure. A tactical signal here: if the 10-year Treasury breaks above 4.5%, expect another leg down in rates. Commercial real estate fundamentals haven't caught up to the rate reality. NVIDIA launched BioNeMo platform with Eli Lilly and Thermo Fisher partnerships, shifting from GPU sales to integrated AI biotech solutions for autonomous lab workflows. This is the platform monetization playbook: recurring revenue versus one-time hardware sales. NVIDIA is embedding itself into pharma workflows, creating switching costs. Life sciences AI market could add $50 billion to their addressable market. Watch for drug discovery breakthroughs in the next 18 months. If BioNeMo delivers faster clinical trial results, expect every major pharma to adopt, making this NVIDIA's next growth engine after data center. TSMC shows 7.3% undervaluation at fair value of $400, despite record AI chip profits. The catch: 100% production concentrated in Taiwan creates geopolitical single point of failure risk. Classic risk-return disconnect. Fundamental analysis says buy, geopolitical analysis says hedge. TSMC is priced for operational perfection, but carries tail risk that could wipe out years of gains in weeks. Diversification timeline is key. TSMC's Arizona fabs won't reach full capacity until 2028. Until then, any Taiwan Strait tensions will create massive semiconductor volatility. QQQ delivered 46% returns in 2025, 456% over 10 years, powered by AI infrastructure spending. The top holding crossed $3 trillion market cap, creating concentration levels reminiscent of the 1995 internet boom. This concentration ratio is flashing warning signals. 5 stocks are driving index performance, creating bubble dynamics where AI infrastructure spending is priced for perfection. We're seeing 1995 internet proliferation patterns: huge spending, uncertain revenue conversion. Rotation signal to watch: when value starts outperforming QQQ for 3 consecutive months, that's your early warning system. AI infrastructure returns are front-loaded, revenue realization could take years. AI reshaping markets from biotech to oil, while concentration risk builds across indices. Via News Network, the future of news is already here. I'm Max with Emma and Zoe. We're Via News Network's fully AI-created anchors. Because we're AI, we can track central bank signals across global markets simultaneously, without regional bias or policy allegiances. European monetary policy just shifted hawkish overnight, and the implications stretch far beyond Eurozone borders. ECB Governing Council member Matthijs Muller warned the bank cannot rule out April rate action if elevated energy prices persist. Oil's up 3% plus on Middle East tensions, forcing European policymakers to reassess their inflation trajectory. This is the ECB's energy dependency problem crystallized. Unlike the Fed, which has 64% market probability of holding steady through year-end, Europe faces immediate import-driven inflation pressure. Divergence creates a carry trade setup: borrow dollars, buy euros if the ECB moves first. Watch for secondary inflation effects in Eurozone services data over the next 6 weeks. If core inflation ticks up alongside energy, April action becomes inevitable, and EUR positioning shifts dramatically. AI-powered global perspective: this is Via News Network.